Sunil Koul is ready. Head of Global Emerging Market Equity Strategy with Goldman Sachs. Sunil, nice to have you back. Sunil, you were bullish at a time when there were uncertainties or concerns in the world. Tariff war, high FI selling, uncertainty around earnings, and slowdown in government spending. Now, one by one, block by block, all the concerns have got addressed. So what is next for the market? Are markets pricing in all the good news?
Look, I think, Nikunj, just to put things in context, I think we had been positive on the Indian equity market, but we also downgraded the market back in sort of September, October last year because the market had done well and we were kind of going through this slowdown in growth and slowdown in earnings. And we had been in that downgrade cycle, right? And obviously, I think from the April lows, not just India, but the global markets have done fairly well. So India has rallied also. And a large part of that is because of the relief around tariffs, right? But you're right. I think if you incrementally thought about what the worries we had coming into the year, a lot of those are behind us. And I would say, look, incrementally, I would say we have been more positive on India. We have been sort of more fundamentally sort of getting more sort of positive. And I think a large part of that reason is because we think this large sort of downgrade cycle we had been seeing in earnings for the last 9-10 months in India is now sort of bottoming out already. We're actually expecting earnings to pick up in the second half of the year. So we are sort of therefore turning much more constructive, even on the India's domestic cycle itself. As you mentioned, things are obviously moving in the positive direction, especially with the policy, with both sort of central bank as well as on the liquidity front. And obviously, global environment is also looking better. So I think things for the equity markets globally are looking better, as well as India. But for India, I think the only concern we have is on the valuation front, which is why, given it's still quite expensive and markets have rallied, which is why I think at the headline level, we have a more modest upside for the overall market, more looking like high single-digit returns for India, lesser than some of the other markets we cover in emerging markets. So we are kind of market weight overall, but directionally, we do think that earnings are going to pick up. And if the market does deliver sort of 11-12% earnings growth, which is what our estimate is, the market can make sort of further gains into the next 12 months, is our view.
So where do we go from here, Sunil? What would influence the script? Will it be tariff? Will it be valuations? Will it be flows? Because first 6 months have been volatile. Next 6 months, which is the second half, will it be rewardful, no returns? How do you see the second half of this calendar year moving?
Look, I think we will see earnings cycle picking up, but the market's already priced some of that in. So I think in terms of absolute upside, Nikunj, as I said, you probably are looking at 5-6% upside. We have a 26,200 target on Nifty, which is sort of a moderate upside. But then because valuations are expensive, we probably have a catch up of earnings catching up to the overall market. But the alpha is more beneath the headline index. So I think there is still a lot of the thematic pockets within the market which are recommending people to buy into, as opposed to buying the headline index in here.
This is Snehi also joining in. Last time when we interacted with you, almost a quarter ago, you did say that it seems like domestic growth has bottomed out. If you take a look at the macro scenario right now, it's a whole different story in terms of CPI, GDP, our PMI numbers latest. They've all been very supportive of growth. In this backdrop, with respect to these macros, what's your growth outlook ahead?
Look, I think the Q1 numbers, you're right, have been stronger. I think the higher frequency data has been sort of also improving, which is why we have sort of touched up our growth numbers a little bit. So we are looking for sort of annual GDP or annual GDP growth of 6.6 for India. So I think that's a reasonable number, especially if you look around the world in terms of growth backdrops. India continues to be one of the strongest, or actually the strongest growth economy, large economy out there. So we are positive on the growth cycle. Therefore, I think the difference only is I think we have a much stronger preference within different segments of the economy. We think the leg of the growth recovery will be driven more by the consumption recovery rather than sort of investment cycle recovery. And so we do sort of therefore advocate people to be more focused or positioned in the consumption oriented sectors in the economy as opposed to infrastructure heavy sectors. But we do, to your question, we do think growth has kind of bottomed out and growth is kind of recovering from current levels.
that thought. We just need to slip into a time-bound commercial, and we'll be right back, and we'll continue this conversation with you on the other end.
Okay, I'd like to just mark the markets right now because there's a teeny mini recovery, just like 5, 7, 10 points from here and there, but that is inconsequential. Sunil, what is your view on the way how the geopolitics is moving? I mean, first it was India and Pakistan, then it became Israel and Iran, now it is Israel, Iran and America. Before we started reading the war history, there is a ceasefire. From a market standpoint, these are events which have historically marked volatility, spike in volatility, spike in VIX, spike in crude, spike in gold. In this kind of a volatile environment, why are equities not panicking?
Yeah, look, I think you're right, Nikunj. I mean, to a large extent, I think if you looked at the tariff risks, which everybody was kind of focused on coming into the year, many of those haven't sort of materialized, right? Obviously, we have sort of put a lot of that on pause, and I think the market has therefore kind of looking through many of these shocks so far. And I think in general, the other theme which is related in here, because as you mentioned, equities have been doing well, but I think the other theme that has been supporting this, and that's kind of resonating with a lot of our clients, is this theme of sort of diversification. The idea that people over the last 10, 15 years have kind of overinvested in US assets, not just US equities, but kind of treasuries and US dollar. And given all the geopolitical volatility and events, I think there is need for people to diversify. And so we sort of saw that play out with people kind of moving money out from US to Europe, and European markets have done fairly well this year. And so large part of that, I mean, there was a bit of sort of fiscal expansion story in Germany and other parts, but a large part of that was now flows moving back to Europe. And now I think what we are starting to see is that trickling down to the emerging markets as well, including some of that in India. And so I think there is higher uncertainty, but equally speaking, I think there's kind of more rotation of money and flows coming back into the emerging markets after like 10, 15 years of underperformance. And that at the margin is also being supportive for equity performance.
There are 2 or 3 moving parts. One is the local moving part, banks connected with interest rates and liquidity. The other moving part is IT and pharma connected with global strength, rupee and dollar. And then the third moving part is the consumer staples and durables, which are linked to consumption, interest rates, inflation and monsoon. Which to your mind is the most exciting moving part for you out of the 3 parts I mentioned? And which to your mind is the boring part?
I mean, look, we have sort of clear, strong views around that, Nikunj. So as I said, I mean, financials, we had been sort of more market weight to cautious over the last 18, 24 months. Obviously, even though Indian equity markets did very well, they did not participate. And I think a large part of that was because of the macroprudential tightness from RBI. And then I think coming into the year with the February policy meeting, we did see a U-turn in policy, and we have become more positive on financials. We have actually upgraded recently financials to overweight. And the reason was that we think, obviously, with RBI being more supportive in terms of liquidity, we think sort of visibility on banks is much better. I mean, obviously, the front loading of the rate cuts and signaling the end of the rate cut cycle means that there is more certainty around the path on NIMs. And we do think as liquidity improves, you could see demand picking up and loan growth picking up, and that should mean better performance for banks. And obviously, we all know it's still one of the more cheaper part of the overall Indian equity market. And so we are quite positive on financials, both NBFCs and banks. So I would say that's where I think the highest sort of positivity is. Then I think consumption, as I mentioned, so we do like pockets of the consumption recovery. We are actually overweight autos. We do like staples and select consumption discretionary bits, especially around the QSR and the tourism theme, which we think is kind of a more structural theme in India. So there are pockets of consumption we do like. I think some of that will start to perform better as we head into the festive season, depending on how monsoons and sowing look. So far, I think things are moving in the right direction. So I would say I think financials followed by consumption, and that's where we are overweight on. We are more cautious on the broader infrastructure segment, sort of cement, real estate, industrials, those guys, and so a clear kind of divergence there. We are more neutralish on the export-oriented sectors. Obviously, we were more cautious with the slowdown in US and the tariff risks, but given a lot of that is getting priced out, we have neutralized the views around IT and pharma. I think at the margin, pharma still has a bit of policy risk because you could potentially see some sectoral tariffs come through in the pharma space. So that still remains a policy risk in that space. But I think IT is a little bit more cleaner, given sort of more cleaner balance sheets. And so, but we are relatively neutral on IT. And so I would say financials followed by consumption, and the last one would be IT in the pecking order.
Okay, so that's the pecking order. That's the way Sunil is positioning his views at the moment. And Sunil, thanks so much for joining us, and thanks for giving us your time. On that note, we'll let you go.